Well, let's get across the market open. Josh Barker joining us from Barker Wealth. Josh, welcome. Assume the brace position.
Yeah.
Obviously, we are expecting a day of heavy selling. This has come off the back of what we've seen on global markets.
Yeah, a bit of a hiccup happening globally, and also, some economic concerns here locally as well. I think obviously the main reason why the US markets peeled off last night was the change in interest rate cut rhetoric, but it's not as justified as probably what it is in Australia. Here in Australia, we had the uptick in CPI and then a really strong jobs data. Those are two data points that the RBA are definitely going to take into consideration, and what most are thinking are going to pause for the foreseeable future now. But the US is a little bit different. They haven't had that data that's really confirmed this change in rhetoric. So it's more so been from the government shutdown, so they don't have the data, more than actually having the data and seeing, okay, that's a justified decision. They may never get that data, so it's kind of, really left the market in a precarious spot as to what is actually going to happen. So I think that the sell-off in the US market is a little bit more speculative than maybe some of the structural issues that are creeping into the Australian market. But, again, these are very strong numbers in the economy that are coming through. There's been some slight hiccups, even for example, the Australian unemployment rate, that's obviously pushed the markets down, but that is a good sign for the overall economy that the jobs market is still quite strong. So, you're sort of getting this lack of euphoria in the market that we've had over the last few months, and just starting to see a little bit of reality that the economy doesn't move in a straight line across all data points. There's going to be, confluence of different data points telling a different story at times.
With a focus on Wall Street, obviously, there's been concern about those stretched valuations, particularly given the AI trade. Well, I mean, we did get a hint of perhaps what was to come in the previous session when we saw that rotation out of tech stocks into the more cyclicals and defensive. Yeah,
we're starting to see a little bit of that rotation happen again, which it's understandable. We in the Australian market, we've got sort of a focus on really strong cash earnings and buying them on quite strong PEs or good PEs, I should say. Whereas you've got names like Nvidia betting on the future, obviously a very different sort of company, but that's trading on 50 times earnings at the moment. So you can sort of see why some of those speculations that would come into the market. And a lot of big banks and institutions have been unwinding that Nvidia position or even taking shorts on it. So, it's something that the market will catch on to eventually.
How much of a risk event is that Nvidia result next week?
It's been such a strong result over the last, 8, 9, 10 quarters. So, you wouldn't expect that rhetoric to really change with the increase in earnings just continuing to beat Wall Street expectations. But certainly if something happens like the economy, if it's going so well for so long and then you see one little hiccup, it could be very ugly for that individual stock. And obviously that has a bit of a flow-on effect, but shouldn't impact things too much, you wouldn't think.
So, given what you're seeing then, Josh, how are you allocating at the moment?
Well, I think obviously the Australian market is a relatively cheaper market, and it doesn't have such high AI frothy valuations. We've got our interest rate risks, but our economy is still quite strong. So I think you want to look at some of the sectors that are most sensitive to this movement, which has been real estate and tech. So sort of starting the deep dive there and, going through, there's some really good quality names that have really peeled off, Goodman Group in the real estate sector. And then you've got names like Xero, which are, come right back ahead of their earnings this month. So there's really good opportunities out there, I think, in those two sectors to pick up what should be a buy the dip in this recent pullback.
What about those defensive sectors such as healthcare? I mean, that has really underperformed.
Yeah.
Of course, led by CSL.
Yeah, I think healthcare is one that, yes, it's defensive, but it's one that's got some structural issues and sort of tariffs around and its own issues of it. Really, what's been the last couple of years, and CSL for what you could argue 7 years. So it's very difficult to say whether that's going to come back into focus as a defensive sector. I'd more lean on sort of picking up companies on a really positive cash flow. We've got a position in the portfolio an engineering stock that was trading on sort of 10 times earnings. It's up about 20% over the last 12 months.
What's that?
Like a podium. So it's still trading on around 12 times earnings still at these levels. You know, you compare that to Nvidia, you're buying it at a fifth of the cost based on its cash earnings. So, you know, there's really good opportunities for strong cash flow generative businesses out there rather than having to, you know, healthcare is always a tricky one.
The banks seen a bit of a wobble there of late, obviously off the back of their results over the past week or so. How are you looking at that sector? I guess particularly also, given what we're hearing, as far as the prospect for further rate cuts are concerned. Yeah,
that's one that has come off a little bit, but probably not as much as what we'd like to see to start to seriously look at it. You know, CBA is still trading at fairly high levels considering the last couple of years. So, you know, maybe if that comes down to 120 or 130, we start to have a little bit more of a deep dive. But still, they're still very high. You know, we've had a 4 or 5% pullback in the market. It's not quite there from looking at it from a valuation point of view, but you know, those names are always strong, so you always want to keep them on your watch list if we do get some serious pullbacks in that area.
And in the resources sector, obviously there's been a focus there on those underlying commodity prices, which has been running hot. Most recently with lithium, are you enticed into that sector?
Yeah, we've got a bit of exposure to lithium as always, but sort of sticking with the top names there again. Sort of the Pilbara's getting the big deals, getting the big contracts, so that's probably the area I want to be in. And you know, even looking at more diversified plays like BHP actually looks quite attractive to finally come back up to those highs and paying that nice strong yield. You know, China's starting to stand on its own 2 feet again in the iron ore sector. So yeah, something like BHP is a really good way to play it as well.